Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, interest rate hikes are back, and both borrowers and depositors are all keeping a very keen eye on the way the RBI and the banks are now looking at making changes to both the lending rates as well as deposit rates. Now, to understand what you can really expect if you are a saving via bank deposits or are looking to borrow loans in the current setup, I'm joined by a very special guest now, Mr. Pankaj Bansal. He's the Chief Business Officer at bankbazar.com. He joins right in. Thank you, Mr. Bansal, for taking the time out for us. Now, as we know, we are noticing post the RBI's out of turn repo rate hike last month, the external benchmark linked framework makes transmission of monetary policy signals quite automatic when you talk about lending rates, but not so much in terms of the deposit rates. So, how are you seeing this movement of interest rates on FDs vis-a-vis on loans?
Yes, actually, I think you're right. After this 40 basis point rise in the repo rates, the loans that you have seen have become expensive. So what has happened is that obviously all these loans, about 40% of these loans today are under EBLRs, which is your external benchmark link schemes, right? It could be either repo or MCLR link kind of a number. Now, the moment the repo rate increases, you will see a shift happening immediately for those consumers who have borrowed loans, right? So this is the shift happens automatically. There is no other market phenomenon that works in. But the bad news for the depositors is that because these are basically a credit output related, calls that a bank takes, as
Yeah.
well as there is a market liquidity which is involved when a bank takes mobilization of your FDs. I think that's where it gets linked. So it is a bank specific phenomena rather than like an automatic link that happens on a loan phenomena. So you will see some of the banks, 10 back in the country we have seen, they have moved and mobilized their deposit rates from 20, 30 basis points, but some
Yeah.
of the banks have not done. So it depends.
Exactly. And that's what my next question was. I wanted to ask because you have seen across the board what's really happening. So, after RBI's move on that 40 basis points hike, in terms of both lending and deposit rates, what has been the case so far among the banks, the trend?
So what has happened? I think you rightly said most of the banks which are on the interest side, they have raised their interest rates on all their retail assets. So whether it is home loan, car loans, or your auto,
Mm.
everything has got hiked up because it's predominantly the portfolio today is on MCLR based, as
Mm.
well as it's benchmarked as the repo rates right now. But
Mm.
when you look at deposits, some of the private banks we have seen they have mobilized deposit, but PSU have still not done it. Some of the PSUs, maybe 10, 15 basis point I've seen in SBI is doing something, but broadly PSUs have not done it because
Mm.
today India is sitting on about 4.5 crore, 1,000 crore kind of cash liquidity, like 4.5 lakhs crore cash liquidity. So liquidity is still there in the market. There is no crunch of liquidity currently that we see from a market perspective. So this transmission from FD interest rates for these citizens will take time because hardly I think about 10 banks have done it. Most of the commercial banks have still not done it. So depending on their credit output, the way
Yeah.
that mobilization will happen, the credit demand in the country will flow. You will see that progression happening even for deposit. But it will take time. It will not be like a quick, immediate, automated movement that you will see.
Right. So, just to help all our viewers really understand, the reason that you pointed out for FD rates not rising in pace with the lending rate is perhaps the excess liquidity and banks having enough deposits right now, not feeling the need to attract any more deposit at this point in time.
That's absolutely correct. Yeah.
Mhm. Okay. Also wanted to ask you, so if, for example, the RBI really raises the repo rate by, say, 1%, what kind of a pass on do you really see on FD rates going forward?
So depending as it will be case to case basis, some of the banks you will see 30 to 40 basis points, you will see a rise will happen. So what we are expecting the next 2 quarters, obviously the rates will rise further, the repo rates will rise further. Broadly in a year and a half from now, we are looking at about 200 basis points rise that will happen because the way the inflation is moving and the way things are moving, that's our overall estimate. So probably about 50-60% of that over a period of time, you will see been passed on the deposit side. So what
Mm.
deposit rates today, you're looking at about an average about 5.5, 6%. Will move to about 7% is what our estimate is in the next maybe 12 to 18 months, depending on when these rates comes into picture. But this is a
Okay.
broad level estimate that we can make right now.
Okay. And in the upcoming meeting, what is your expectation from June 6 to June 8? Will the RBI again, go ahead and hike the repo rate this time, and by how much?
So I think that's what the
Mm.
market is envisaging. We will not be able to comment on that, but broadly
Mm.
that's the news that we're getting, that every quarter, every month you will see some rates rising till the time the inflation comes back to the same 4.5, 5 levels, percent level. That is the broad understanding that we have from a market perspective.
Okay. And in the end, I wanted to ask you, for all those borrowers and depositors really looking at us right now, do you see the deposit rates unlikely to match the rise in lending rate, even if we see a gradual improvement right there?
So yeah, that's our view also. It will take time, Sakshi. What we are seeing is that it will be like if my interest rates move by 40 basis points, my deposit rates will move by 20 to 30 basis points. I don't
Hmm.
see that shift like 40 to 40 basis points will happen between the two products together. So and obviously, deposits takes time. As I told you, it's a function of a bank to bank mobilization of funds, the kind of credit demand that they built in, the amount of liquidity that the country has. So it's a function of two, three factors, and depending on every case to case basis, you'll see that interest rates rising on the FD side. So I think that's the view we will have for even consumers as well. And obviously, till inflation is about 7.5%, 8%, your deposits about 5.5%, 6%. Obviously, we're in a negative return kind of a scenario even for consumers right now.
Okay, understood that. Well, on that note, thank you so much for being with us and sharing all the insights on what can depositors really expect. Well, for now, the lending rates that have gone up immediately following the RBI's 40 basis point hike, the deposit rates have not really remained sticky, and they're likely to remain sticky even for a little while from here on. And it'll take time to see that much of an improvement on the deposit rates front right now. Thanks a lot for being with us. It was great speaking with you, Mr. Bansal.
Thank you, Sakshi.
If you like the video, do like, comment, share and subscribe.